Good morning, everyone. In today's video, we're going to talk about a slightly different topic, but a very, very important one: how to protect yourself from market crash situations. So, generally speaking, there are different types of strategies to protect yourself, both when the market is going up and when the market is going down. And then finally, we'll look at some strategies that are typically used by large investors to protect themselves, generally in cases where they've gotten stuck in the market. And this happens quite often. Don't think that investors with very, very large portfolios always manage to buy at the bottom and sell at the top. That just doesn't exist. Maybe they try to get close. Maybe they even manage to get close. But generally, what saves them in most cases is knowing how to manage their positions, either because they've diversified, and I'll show you this now. Generally, as is often the case, they diversify either because they are able to potentially accept losses, or simply because, since it's not feasible. It's not always possible to buy at the lowest and sell at the highest. If, for example, their portfolio has dropped a certain percentage from its all-time highs, they accept that profit, just to avoid affecting the rest of their gains. And very often these investors, since they know that when the market drops, it can drop much, much more. Very often they accept those reduced profits compared to the portfolio's all-time high. Then they take that capital and reinvest it, essentially perhaps at much lower levels and maybe in a more diversified way. Anyway, before we start, I obviously want to tell you that I am not a financial advisor. These are not strategies meant to tell you what to do. These are just some points for reflection that, based on my experience in previous bear markets since 2016, I have seen many investors use these types of strategies as well. Just to clarify, some of these, actually several of these, are strategies that I use myself and that, in my case, have helped me protect myself even from significant crashes. So first of all, let's talk about it. A moment to go and diversify when the market goes up. That is when, obviously, the market has a bull market. What are the smartest things a person could potentially do? Simply have multiple wallets with multiple different trades. It basically means that if a person has, let's just throw out a random number, 10,000 euro invested in the crypto market, it might make sense to invest them in different ways. What do I mean by that? Maybe basically use a percentage for a crypto portfolio and another percentage still for a crypto portfolio, but for a trading portfolio, okay, because obviously you need skills, you need to study, do a lot of backtesting, do a lot of forward testing. Forward testing means practicing live, okay, and then you also need to gain a lot of experience. Because when it happens to you, maybe a crash of plus 50, minus 50, minus 60%, maybe on coins even minus 80%. When you have a percentage of your portfolio in trading, obviously the trading portfolio will have a completely different performance compared to a long-term crypto investment portfolio, right? Because basically the trading portfolio operates on completely different time frames, much shorter term. And above all, if the market goes down, the trading portfolio paradoxically can even make a profit. Why? Because with the trading portfolio, you can also take short positions. So this already helps to diversify risk when there are major crashes. Then another type of movement, which in my opinion is very, very smart. Another way is to diversify with an additional portfolio, even through stocks or commodities or any other type of financial instrument. That depends on your own expertise or the expertise of your financial advisor who will guide you in case you have one. Generally speaking, for example, I'm not knowledgeable about commodities, and as a result, I'm more skilled, or rather, sorry, it's not as a result, but in my case, I'm much more competent with stocks, both with stocks and with trading. So in my case, I have diversified a lot, both with my trading portfolio and my stock portfolio. In my case, my stock portfolio is very close to all-time highs, also because the stock market itself is currently near its all-time highs, whereas paradoxically, when the crypto portfolio started to drop, that's when obviously you need a bit of risk management. Maybe in my case, I managed to sell near the highs, buy back during the drop, and during the decline, my crypto portfolio took an additional hit. So I didn't get hit by the whole thing. The drawdown from the peak, in this case in the crypto portfolio, but I only got hit by, for example, Ethereum. I had an average price around just above $3,000, around $3,100 and something. Obviously, right now we're below that level. So that loss, I took it there. It's fine, manageable, it's normal. And in my case, since I have both a trading portfolio and a stock portfolio, as well as other liquid assets, which I have diversified, and I'll show you that in a moment, the drop in the crypto portfolio was less significant than if I had gone all in on the crypto sector. And believe me, even if it sounds crazy, many people are all in on crypto. And this can definitely help you with this kind of hypothetical situation. This diversification can help you take it into consideration. In my opinion, it's something worth thinking about because it basically reduces your risk within the market. Then moving on, there's another type of diversification. When the market goes up, it's important to gradually lighten your position by taking consistent profits during the rise. To do this, maybe it's about diversifying, perhaps into stocks, or maybe adding to your portfolio, but also to buy other types of assets, such as real estate or even land. Obviously, for assets like real estate and land, you also need more liquidity, but basically, when simply put, your crypto portfolio keeps rising, you can also just consider and say, okay, great, I see the market has gone up a lot. I can also consider buying gold or silver contracts, or for example, some. Now, this might, so to speak, be the subject of insults from some people. For example, when someone sees their portfolio has grown significantly, they might say, look, I'm going to buy myself a car. It's true that a car is something that brings you expenses, so it's not really an investment in the strict sense. However, when you go to, just for argument's sake, buy a used car lose value much more slowly compared to the volatility that a crypto portfolio might experience in a bear market. Because there have been many cases where in bear markets, the assets lose even 90% of their value. This is a very common thing. So, generally speaking, a car, even though strictly speaking, it's a liability, so it's not a smart thing to buy, loses much less value compared to that. Now let's look at some smarter examples. Simply put, diversification into commodities, into goods, as I was just telling you. For example, gold and silver, or potentially land, or possibly small apartments, if you want to start another type of business. Or maybe you simply use that liquidity to start your own business, like becoming an entrepreneur in any other sector. There, obviously, you may need much less capital compared to what a property might cost. I'm referring to businesses that are perhaps more cutting edge, a bit more technological. I'm not talking about starting a company, let's say a textile company, for example, okay? Or any other type of business that requires significant investments in machinery in addition to expertise. So generally, when someone wants to diversify, there are many types of activities that help you reduce your risk. Now, diversifying while the market is going down. Why? There can be situations where someone gets stuck inside, and by the way, it's also a strategy similar to the one that's used in the example I showed you, even for investors who may have been, or rather ended up stuck during a bear market. Now let's take a look at it. That is considering selling even if the portfolio is no longer at its all-time highs. So maybe if you, like in my case, have been in since the start of the 2022 bull market, okay, 2022 to 2023, the market, meaning BTC, went from $15,000 to $120,000. It's understandable that you might not manage to sell at the all-time highs, but even now we're still very far from $15,000. And generally, as you gradually diversify with other assets, you still have the majority of your wealth, either locked up in certain assets or maybe just diversified among stocks, portfolios, trading, and a bit in crypto as well. So generally speaking, you might want to start considering the possibility of selling your entire investment portfolio, even if it is currently not sitting at an all-time high, just like the specific example I mentioned at the very beginning of our discussion. Videos of potential big investors, when there are crashes like these, focus especially on assets that are less weak. What do I mean? I mean that, for example, when you look at the Bitcoin chart, dominance, when the Bitcoin dominance chart hypothetically has reached a potential support level, and hypothetically from here it could start a new upward impulse. Why should it start? Obviously, this is just a general analysis. As long as, for example, this support here on the monthly RSI chart holds, it's more likely that it will start from here. If an upward movement does start from here, it's likely that Bitcoin will lose less value, or maybe even gain more compared to the rest of the market. Altcoins in short, when this is the chart of Bitcoin dominance rising, it means that Bitcoin is outperforming, for better or for worse. The rest of the crypto market, many investors, when they get stuck, and we'll look at this aspect as well. Many large investors, when they get stuck in the crypto market, what do they usually wait for? They wait for two things. The first thing is to see the initial rebounds. After that, to trim down the market, they reduce their altcoin portfolio to do two things, either to get liquidity or to consider buying at much lower levels, or simply to shift their risk to less risky assets. I don't just mean other assets like stocks, etc., but also simply at that moment. And in case they don't want to exit the crypto market, it's simply a matter of moving into Bitcoin. Why? Because if Bitcoin dominance starts to rise, which is very likely in bear markets, generally the assets that lose the least are the ones that are also the first to recover. This also happened in 2021 to 2022, when the stock market began to crash significantly. Which assets were they? I'll show you the chart in a moment. Once the S&P 500 hit its low around here, basically around October 2022, which assets were the ones that took off, mainly during the rally? Generally the Magnificent Seven, right? That is the most solid companies, for example, Apple, Microsoft, Google, Amazon, and so on. Why? Because when a bear market starts, or not, there's no guarantee, thank you. That might be the bottom, and as a result, the decline could continue. Investors with large amounts of capital are fully aware that they will never be able to catch the bottom with most of their liquidity, both because they manage risk and because they generally hold many assets in which they're interested, and as a result they diversify. But when the market is already low, what is the potential asset that an investor with a lot of liquidity is interested in acquiring during a bear market? Typically it's assets like stocks, crypto, or anything else. Ones that have the highest probability of not failing in a few years because they are excellent companies or outstanding projects. As a result, in the stock market, what could be the Magnificent Seven? And in the crypto market, typically these could be BTC and Ethereum, especially at the beginning Bitcoin. And that's why at the start of every bull market, Bitcoin is always the first to take off. And then afterwards, it spreads liquidity throughout the rest of the crypto market, mainly to Ethereum. And then after that, the rest of the market, crypto altcoins. And the same thing works for the stock market. So another type of entry or capital protection that many big investors use is exactly this. At the first rebounds, they sell altcoins to move into BTC. And from there, typically it starts up again. Bitcoin dominance rises in favor of Bitcoin, and unfortunately to the detriment of the rest of the crypto market. All right, now another situation. The last thing, when a big investor who also has expertise, or maybe relies on financial advisors, groups, hedge funds, etc., who provide assistance, and so that person, or in any case, relies on people with experience. Generally, what they might consider doing is simply liquidating some assets. That obviously these might have much lower volatility, or maybe it's just liquidity they already had set aside, and they gradually inject it into the market once it has already dropped significantly, and once it starts to show real signs of a bottom. Or in any case, when that asset shows it's very close to being at a significant discount. Obviously, to do all these types of diversification, you always need skills, but of course that's true in the world of investments. In any field, you need skills to make money, because I've never seen people without skills make a lot of money. And maybe there can be cases where people without skills make money, but usually once they do, if they lack skills, they end up losing everything and then some. I still hope you enjoyed this video, and maybe it can be useful to give you some food for thought, perhaps for the future. See you in the next video. Take care, guys.